Welcome to the Market Mosaic, where every week we are looking at the intersection of macroeconomic data, stock market technicals, and market internals, things like breadth and sentiment, to try to figure out where the market could be headed over the near term. We're coming off a losing streak for the S&P 500, so the S&P had its fourth decline over the past 5 weeks. And really, the big driver there has been a sell-off in artificial intelligence and mega cap growth stocks. We're seeing a rotation out of those names, and it's continued weighing on the broader market. But even though the S&P is down for the past 5 weeks, it's still within close proximity to the prior all-time high. So let's just take a look at the S&P really quick, because I think there's some very key levels that we want to keep an eye on in the week ahead. And you can see, really going back to the start of the year, or even going back to December, the S&P settled into a range. You can see we've tested around the 6,800 or so level on the low end, and we've rejected off the 7,000 level multiple times over the past couple months. And so that's really the range you want to keep an eye on. The black line on here is the 50-day moving average. You can see we've been chopping around that level there as well. So really, even though the price action, it feels very bearish, especially when you look at the markets, some of the past winners in the AI trade, and so on. It feels bearish, but big picture, the S&P is within 2% of the prior all-time high, and we've been trading in a really tight range, and this range break could tip the next big directional move in the market. But here's the thing, even though we're only 2% off the highs, you're seeing a jump in fear across the market. So we're seeing bearishness among retail investors hitting the highest level in 3 months. We're seeing a spike in volume, put option volumes. And while the headlines, if you read the headlines last week, there's a lot of fear circulating around AI's disruptive potential on various industries and what that means for the jobs market. But I believe the real driver of some of the volatility we've seen lately, it really stems from extended valuations, especially on the growth side of the market, and a shifting outlook for interest rates. So I think a big driver last week is that, while we've got these concerns over AI's impact on the labor market, you had the January payrolls report came in well ahead of expectations. There were 130,000 jobs added during the month that easily outpaced expectations for 55,000. And so with stronger data, that report is clouding the outlook for further rate cuts from the Federal Reserve. Market implied odds point to 2 quarter-point rate cuts this year, but if you look at where the 2-year Treasury yield is at, the 2-year Treasury tends to lead changes in Fed funds. It's come up to the low end of where the Fed funds range is at. So in a way, the 2-year Treasury yield is signaling that the bond market really doesn't expect any more rate cuts from these levels. And that's a problem, because when you have AI and growth stock valuations running well above their historical averages, the shifting rate outlook is making their share prices very susceptible to a less accommodative stance on monetary policy. So if we're not going to all of a sudden be as dovish with monetary policy, that could present an issue. And we did have a cooler than expected consumer price index last week that offered some relief against stronger economic data and how that impacts the rate outlook. But the details of that report, it points to inflation pressures building in some very important categories. So this week, I want to look at actually some historic levels of volatility unfolding underneath the stock market's hood, and how that's contributing to a rising level of bearish sentiment. But the economy is holding up a lot better than expected, so we'll take a look at some growth forecasts and how that's boosting corporate sales and earnings. And then I want to go into that CPI report and show you why inflationary pressures are persisting. All right, so the January payrolls report, that was the latest evidence that the economy is performing way better than expected. And look, jobs data is a lagging indicator. What we could finally be seeing is that the labor market statistics are catching up to an acceleration in other indicators that's already been underway. So again, we had a growth scare around the trade war last year. We've seen a lot of improvements in other areas of the economy since then, and the labor market tends to be a lagging metric, and so it might be finally catching up. But here's the thing: since last year's trade war, the initial rounds of the trade war, there's been a steady improvement in GDP growth estimates, and that's what this chart is showing. So it shows how real GDP growth has evolved for 2025, which now we got that year behind us. But then how 2026, the orange line on here, is evolving as well, and you can see 2026 GDP estimates are higher than they've ever been when you go back to tracking how that's evolved back to last year. But then here's the other thing. this is how these dots, this is how actual GDP has been coming in. So actual GDP has been coming in much higher than expected. So we're seeing this trend of positive economic surprises. And here's why that's important. So recovery in economic forecast, that is supporting accelerating growth in corporate sales and earnings. I showed a chart earlier this week in Mosaic Chart Alerts that how the median earnings growth for stocks in the Russell 3000 has been rising since the start of 2025, and it just hit double digits, moving above 10% during the fourth quarter. Now, why is the Russell 3000 important? Because that's a very broad index. So it covers large caps, mid caps, and small caps. And it's not just earnings. Quarterly revenue has been rising as well. So that's what this chart on here plots. It plots the year-over-year change in revenue for the S&P 500 by quarter, and you can see the fourth quarter of 2025, we'll probably still have a few more numbers that need to come in to complete this, but overall, this number should stay close to where it's at right now at 9%. If we come in at 9%, that is the strongest quarter for revenue growth since late 2022, so in over 3 years. So again, we're seeing these strong economic data, rising forecasts for GDP growth is being reflected in corporate revenue and earnings data as well. And that rising earnings, given where valuations are at, rising earnings are key to sustaining the rally in the S&P 500 right here. All right, so while the S&P is only 2% below the prior high, right around the 7,000 mark is where we've topped out at. We're in close proximity to that, but there's been a big jump in bearish sentiment. So, and I think a lot of that has to do with some of the market's most popular stocks are the ones that have been under greater pressure. So stocks leveraged to the AI trade like Microsoft or Palantir, they saw their peaks months ago, and they've both experienced sharp declines. We're seeing that across a number of names, again, in the growth space, AI trade, software trade, and so on. And what that's doing is it's sending both survey and positioning-based measures of investor fear higher. So, as a survey-based data, the AAII, they survey retail investors. Bearish outlooks jumped to 38.1% last week. That's well above the historical average, and that is the highest level of bearish views since this past November. But what I also like to watch is how investors are actually positioned. So a survey, is one thing. They can tell you how they feel, but positioning shows you how they're actually voting with their money. And there has been a big spike in put option volumes relative to call. So a put option, again, is a bet that pays off on the downside, holding all other factors equal. Put options are designed to gain in value when the stock or security that it's tied to is declining in value. And what this line on here tracks is a ratio of put option volumes relative to call option volumes. So when this ratio is rising, that means there's more puts being traded than calls. And we're at the high, near the high end of where we've seen this ratio here in recent months. And this is important because this is a contrarian indicator. When there's too much bearishness, that can be a contrarian bullish signal. So pay attention to this and what we're seeing in those surveys because of that. All right, we're going to unpack this CPI report we had last week a little bit. So the headline figure on consumer inflation, it looked favorable on the surface, but there's key underlying components that show pressures continue building. So the CPI came in at 2.4% year over year for January. That was a little bit below expectations, and it was the smallest increase in CPI since last May. But there's certain measures of core inflation continue to run at elevated levels. So what this chart on here shows is core services CPI. And so this is focusing on things like housing costs, health insurance, auto insurance, and so on. And core services rose by 0.4% month over month, which comes out to 4.8% annualized. So the red line on here shows core services CPI year over year. But what this blue line on here does is it takes that monthly change and annualizes it. And based on that, you can see we had the biggest spike higher in core services in a year. And that's important because you can look at core services. If you look at core services and you exclude housing, that's something called supercore inflation. That can be a leading indicator of where inflation is heading. And supercore rose by even more than what this chart on here is showing. It rose by 0.6%, which is 7.3% annualized. So again, we're seeing these key underlying services categories coming in pretty hot in the month of January. So we'll see if that trend persists. But if it does, that's some bad news on the inflation outlook. All right, so it might look like it's pretty calm on the surface of the stock market. Again, the S&P has been trading in a pretty tight range for the past couple months now, but there has been a big jump in volatility across the average stock. So we've talked about this big rotation that's underway, and the market leadership has changed dramatically. So growth in AI stocks are suddenly struggling, overall, while value and cyclical sectors are outperforming. And so what the chart on here is showing, though, is the return dispersion in the S&P 500 over the past month. And here's the thing, again, while the S&P has been relatively flat over the past month, the average stock has moved by 11%. So this looks at the absolute average move in the underlying stocks in the S&P 500 over the past month. So the S&P doesn't look like it's doing much on the surface, but under the hood, the average stock in the S&P is seeing a huge price swing. Again, it's pushing toward 12%. And what's remarkable about this is usually that type of return dispersion happens during bear markets and times of crisis. So, we had the spike coming out of the pandemic. This was 2008, coming out of the great financial crisis. And then, a market that I think shares a lot of similarities to what we have today was the internet bubble. So the 2000.com bubble, and that bubble bursting in early 2000, it's when you start to see a lot of that return dispersion. So again, given the similarities that we share today compared to back then, it's worth noting this big uptick in return dispersion as that rotation happens and as that leadership is changing. All right, it's a holiday shortened week, but we'll have a couple key reports we want to keep an eye on. First thing will be with the FOMC meeting minutes, so the minutes of the last Fed rate setting meeting. A big thing we want to watch there is any clues on how the FOMC is leaning toward further rate cuts, and maybe things that they're watching to signal that they do need to ease rates further versus maybe not doing so. You also want to look for signs of disagreement on the FOMC. There's been a lot of more dissent recently than what you usually see between officials thinking that rates need to be cut versus held steady for the most part. Then also, we'll get the core PCE index. So for the month of December, now this is an important one to watch because this is the Fed's preferred inflation gauge, and some of those things that were reported in the CPI report that feed into this could actually help push this a little bit higher, make this a little bit harder than expected. So we'll keep a close eye on PCE. All right, one thing to keep an eye on this week as a trade idea. Last week I gave Volatility Holdings as a trade idea. They had a big jump higher following earnings, and I think this is another thing to keep an eye on because we have seen stocks in what I'll call the AI pick and shovel energy plays have been doing very well. So, GE Vernova is one stock that's been breaking out recently. They're power distribution, power generation company that has end market exposure to data centers, while Solaris does as well as a power generation company, data centers being a primary end market that they focus on. And we had, this pop on Friday last week on a big jump in volume, so I'm going to keep a close eye on the stock. I want to pay attention to the 60 level. We did not close above 60, but that's what I'm going to be watching for in the week ahead, is if we can have some follow through above 60. The basing structure is hinting at some nice accumulation. So after we had this peak back in October and the initial pullback, you can see the pullbacks since then have grown shorter in terms of both price magnitude and time, so that's important to note. And so we want to keep an eye on the 60 level heading into next week, see if we can get a breakout in ticker SEI. All right, that is all for